Hello, I'm Lelda Smeets for the Finance News Network, and joining me from Kingston University, London, is Professor Steve Keen. Steve, welcome to Sydney and to FNN.
Good to be here again.
So Steve, when we last spoke in January, you said that there were some cracks in the global economy. How have these cracks fared since? And where do you think they may be the deepest?
Well, the deepest is obviously China, because China's been involved in the biggest private credit bubble, I think, in history. And when it stops growing, then you're going to have a downturn in China, which would be quite severe. But globally, the prediction I made was based on the fact that we had too much private debt. You would never get a level of credit-driven demand like we had prior to the crisis again, and therefore all the expectations of growth around the world were going to be disappointed.
Okay, now you've said China, but obviously the spotlight has been on Greece recently as well. You're in London. Now, do you think that the events in Greece have been better or worse than you were expecting?
Worse. I think largely I believed, and I think Yanis believed it as well, that with a political mandate there was a chance to go and change the program and move away from austerity. Instead, in some ways, the European Union took the fact that they voted against austerity as an affront and basically said, well, if you didn't like it, have some more. And they've actually made it more extreme and more draconian and more disastrous in the long term than I expected would ever happen.
Okay, in the meantime, these events seem to continue to escalate. What are you going to be watching out for now as the next major development?
Well, they're going to start imposing the austerity program. It will mean that businesses collapse because they're going to go from a VAT rate of about 13% to 23%. They're going to be taxing the one area which was a growth area, which was tourism. That's going to cause tourists to go to other countries because they haven't got any option to drop prices. It'll be putting it on top of current prices.
Okay, if we can speak about another key central figure in this debt drama, it was Yanis Varoufakis, your friend also, who is now the ex-finance minister of Greece. How would you rate his performance recently?
Well, as an economist, brilliant. As a politician, he didn't realise the brutality with which politics is played at that level, particularly when it's played by unelected officials inside the European Union. So he went in with the expectation I would have gone in with myself, was a fairly naive belief that with a political mandate behind me to some degree I could change the program. He's found that political mandate actually basically annoyed them, and they've actually gone even more hardball. And so the situation I think is disastrous, but it's truly the fault of the European Union, and in particular the finance minister for Germany, Schäuble, if I can pronounce his name properly. He's the real villain in this piece. He's the one who's made it disastrous. And we look back in history, he'll be the one who'll be blamed for the breakdown of Europe.
So Steve, moving on to the US now, when we spoke in January earlier this year, you said that rates look likely to remain on hold. Many are tipping that we could see a rate hike as soon as September. What's your rate outlook currently?
Well, it's quite likely they're going to put rates up because they don't understand how the economy functions. If you read Yellen's most recent academic style paper, the word equilibrium turned up about 20 times in this little document. The only words that were more frequent were the, of, a and if. You know, it was ridiculous how much they believe the economy is an equilibrium system.
So when do you think we'll see those rates go up?
Well, probably quite possibly September is a reasonable target.
And what will be the likely outcome?
Drastically more impact upon the economy than they expect, because what it will do is potentially trigger the private sector back into deleveraging again. The reason the economy has been recovering is because the private sector is borrowing money once more, and that borrowing money is stimulating demand and income inside America. If the interest rate rise is enough to push people over the edge with their financing costs, they'll start paying their debt down. That reduces the money in the economy, it reduces demand, and it'll cause the economy to go back down again. So basically they're replicating the same disastrous process that Japan has been through for the last quarter century.
Okay, if we can look at Australia's interest rate environment now, you correctly predicted that we would go from 2.25 to now a key cash rate of 2%. Where do you think the Reserve Bank of Australia will move next?
Well, the only thing they can do is cut rates. And the trouble is when they cut rates, they continue inflating the property bubble that's here as well, and they're driving down the dollar, which they drove up by putting rates up wrongly as they did in the last 5 or 6 years. So I think they're going to be pushed down, and hopefully finally, now that Glenn Stevens has finally used the correct word to describe the Australian property market, which is crazy, then maybe they might try to bring in some prudential controls as well.
And again this year, do you think we're likely to see that rate cut occur this year in Australia?
Oh yeah, I mean, the collapse in our terms of trade has been more dramatic than they again expected. It was roughly the magnitude that I thought was going to happen, because we always overshoot. And now we're going overshooting down as well. So in terms of trade collapsing, particularly if China starts to fall over this year, which is highly likely, and that cuts our export volumes as well. And at that point, they'll be driven down to 1.75 or 1.5 by the end of the year.
Certainly. Now, if we can look at property, everyone always loves to hear your property views. So are we going to see you buying property in Australia anytime soon?
I'll buy property for somewhere to live at some point, and I'll be basically ignoring the bubble and buying in cash. Because I'm not doing it for levered speculation, I'm doing it for somewhere to live, which is how we should treat housing. Making it into a speculative product is part of the massive distortion of capitalism we've allowed happen in the last 25 years.
Okay, and for investors, people wanting to make some money in Australia, where do you think they should be looking for value if it's not the property sector?
I'd be taking advantage of declining rates and the impact on bonds, and if you wanted to lever up that way, you might find some way of getting a gain out of it. But this whole search for gain, whole search for a yield that exceeds 1%, which frankly is the long-term sustainable rate of growth of assets in the capitalist economy, trying to get rates of 3 and 4 and 5 and 7%, it's a recipe for a crash at some point in one of those markets.
And Steve, finally, if we can just take a step back, look at the global economy, what will you really be paying attention to in the coming months? Where are the hotspots?
Well, basically China. China has to be the next one with the big crash. And then after that, what happens in Europe and the potential political breakdown in Europe. I don't think that we're going to see the rise of either a military coup or a fascist takeover in Greece this year, but I wouldn't rule it out for 2016.
Okay, thank you so much for your insights today.
Thank you.